Good morning, options traders, and happy Friday to everyone. I hope everybody survived the week with our Fed announcement this week, and hopefully, we're going to get some continued rallies going on here. But we got another question from one of the traders in our group asking, why use a broken wing butterfly? Now, actually, it was a two-part question. He said, why use it, and then how do you repair it? Whenever you hear the word repair from a trader, what they're looking for is the secret button that you can push. It gets all of your money back, and we try again. There is no such thing as a repair strategy. I know a lot of people throw that term around out there, but all it is a new trade, hoping that you make up for the losses on the previous one. So I would like to get that out of the way, because if you tell traders, oh, don't worry about it, you can always repair it, then they go and take a whole bunch of risk without worrying about it because they say, I can always repair it. As if it's some type of an insurance policy that you just say, you know what, let me start over, and it puts all of the money back into your account. Not going to happen. Now, there are ways that you can adjust really any strategy, but certainly a broken wing butterfly. But we do that really because of new outlooks, and depending on how we pull them apart, which I'll talk about later in this video, that might create new sets of risks and rewards, but they're not repair strategies. They're just trade adjustments. So that's definitely a little something different. But for this video, let's answer the question, why use a broken wing butterfly? As always, before we do, please be sure to click like and subscribe. Greatly appreciated, and definitely helps to promote the channel. So this video is a little bit of a mixture of previous ones that I've done before, but I'm going to try to bring them all into one video to really answer this question. So I think the most important thing to understand whenever you're talking about why should I do a certain strategy is for one reason only, that you have some type of an expected edge. If there's no expected edge, there's no reason to do the trade. You don't do it just because you think something is going to happen. So as an example, let's go to the game of roulette, which I've talked about many times. It's a great example. And we have lots of different bets in roulette, but let's say you bet on a single number that pays off 35 to 1. And so this is something that a lot of traders look at, is this risk-reward ratio, and they'll say, oh, this is great, so let me do it. Or, I think the number is going to land on number 12. Or, I think it's going to land on red or black. This is what I think, so let me place a trade. Not a good idea. Because if you have a negative edge, or an edge acting against you, you don't want any part of it, no matter how good the rewards might look. So if you go to the roulette table, there are 38 spaces. So you could take $38, cash them in for $1 chips, and cover the board. So now you're guaranteed to win. What could be better? Well, the question is, what's your profit? Well, like the casino advertises, you're going to win $35. You get the return of the dollar, because you don't lose that if you win the bet. So you get a total return of $36, but you spent $38. Remember, there's 38 spaces on the wheel. So if you spent $38 and you get $36 back, it's a loss of just over 5% every single time that you play, at least on average. So why would you want to take part in this and say, well, I think it's going to land on red, or I think it's going to land on 12. This is what I think. And yet that's how options traders approach most of their trades. I think the stock is going up. I think it's going to sit still. Let me place this trade. And they do it without any regard to the prices. What are the prices that we're facing here? That's what you need to focus on. So there is a three-strike pricing relationship that you need to understand. This is really what dictates whether it's a good idea to go into a standard butterfly or a broken wing. And what it says is that the center strike must be less than or equal to the average of the outer strikes. Now, being equal to would be a real oddity, but it could happen. But most of the time you're going to see, if you check your broker's platforms, that center strike will be less than the average of the two wings. So for example, let's say that you're looking at the $100 call trading for 5, the 105 call may be trading for 4, and the 110 call trading for 3. There are 3 consecutive strikes and same stock and same expiration. So what this relationship is saying is that this center strike right here, the price at 4, has to be less than or possibly equal to the average of the outer two. So the outer two are 5 plus 3 is 8 divided by 2, and that gives us 4. So this would be the maximum it could ever be, right? That's what the relationship says. It must be less than or equal to. So in the real world, that would be the absolute maximum. But what happens if for some reason it were greater? Well, what that would do for your risk graph is it would shift it above 0. It would be an arbitrage. And we know that those are few and far between, and if they do exist, they're not going to last long. So that is the reason for this relationship. And once you understand that, now you can look at the 3 strikes and see if there's some type of a pricing discrepancy. And again, that would give you the motivation to enter a standard butterfly or a broken wing. So the broken wing butterfly is the same idea, but we have unequal spacing between the strikes. So let's say you have the 100, 105, 120. See, now I've got a 5-point difference between the first two, but a 15-point difference between the second two. If this were a standard butterfly, it might be the 100, 105, 110. But now I've skipped over a few strikes and gone to the 120. And what that's going to do is to make the right half of this graph sit much lower. Looks like a broken wing kind of sitting lower there on our stylized butterfly. Now see, normally if I went 100, 105, 110, we start making gains through here, then we go into negative deltas, and right here at 110, we would flatten out because we would be long the 110 strike, but we're not. So we continue taking losses until we bump into the 120 strike. And because there's now 15 points of difference on this side, this right side can sink much lower. So one of the things that you'll hear from most traders, the reason for doing a broken wing butterfly, which is not true, but this is what you'll hear, is that you want to get this left side to really shift higher above 0. You're trying to get this credit, and so it's almost like it's a ratio spread with a little insurance policy over here. You're thinking, clue that it's a bad idea, thinking that the stock is going to stay in the center, but just in case you're wrong and it falls, you've at least got something to show for it. But you're leaving this risk over here on the right side wide open. And if you're dealing with prices at basically fair value, you don't want any part of this. Don't get lured into the word credit, or that if it falls you're going to make something, or if it stays still you'll make something, or you've got wide break-even points. Those are not reasons for doing a trade. Remember, roulette pays off 35 to 1. Sounds like a phenomenal deal until you start including the prices, and you'll see it's something you don't want any part of. So how would we make a better decision about this? Well, if we have unequal strikes, there's a little tweak that we have to make to our formula. So let's say we have the 100, 105, 120. That's the example we saw. Notice that between the center strike and the right wing here, we have 15 points of difference. 120 minus 105 is 15. But if we look at the width of the entire spread, 120 minus 100, the entire spread is 20 points wide. But 15 of those points lie here in the right wing. So we know that the right wing makes up 75% of that distance, just 15 out of 20. And therefore, if it makes up 75%, we know that the left side must be made up of 25%. And if you wanted, you could do the calculations and say that there's 5 points of difference here. Out of 20 total, 5 out of 20 is 25%. But if the right side is 75% and the entire area is 100%, we know that this part has to be 25%. Once we have that, now we can do a tweak to our formula. So understand that because I have fewer deltas on the left-hand side, I've only got 5 points wide, I need to put more weight out there. I need to put more contracts. So think of it like a seesaw. If you have one person sitting much closer to the balancing point and another person sitting further away, the person who is closer has to be heavier to make up for just that very narrow distance. And that's what we're doing here mathematically. So what I need to do is to take 75% of the $100 calls price plus 25% of the 120 call price. And if you do that, you'll come up with a number, and the center strike must be less than or equal to this value. So it's exactly the same idea, and we could actually use the same formula for a standard butterfly. We would just get 50-50. But when they're unequally spaced, we have to do this little tweak to them. So now the question is, and this will be important later, is how could we balance this butterfly? Well, remember that 15 out of 20, or 75% of that distance, is on the right wing. 5 out of 20, or 25%, is on the left wing. So one way to figure this out is, how could we write 75%? Well, that's 3 out of 4. So if we write 3 out of 4, what we're going to do now, just like we would do with an odds ratio. So if you had a 75% chance of winning a certain game, how much should you pay? That's where an odds ratio comes in. And the way we're going to figure it out, we're going to take whatever number is on top in the numerator, and we're going to swing it down below. And then we're going to say, in this case, 3 plus some number gives me the denominator. So that would be 1. So we're going to change this fraction to 3 over 3 plus 1. Notice it's still 3 over 4. All right, so do you see what I did? Is I took this 3 and I pulled it down to the bottom, right there. And then I said, what number do I need to add to that to give me this number? And so this becomes our odds ratio. If you have a 75% chance of winning a game, you would have to bet 3 to make 1. Because again, you've got 75% of the probabilities in your favor. You have to pay a lot to make a little. We could go in the other direction. We could use this number down here and say it's 1 out of 4. How do we figure it out? Swing the 1 down below, and then say, what number do I need to add to it to give me this number, the denominator over here? So that would be 1 over 1 plus 3. Same difference. It's telling us that we would need, in this case, 3 times the number of contracts on the left wing because it has the smallest distance. So for every 3 contracts I put on the left, I could put 1 on the right, and then that would balance out that butterfly. So let's go over to an Excel spreadsheet, and I'll show you why you generally don't want to enter a broken wing butterfly by itself. Okay, so now we're into an Excel spreadsheet, and I've got a little program here where we've got our butterfly spread, buying 1, selling 2, buying 1. It's the 100 strike, 105 strike, and the 110 strike. And so this is a standard butterfly, and we can see this is our risk graph. This is what a regular butterfly looks like. But now, what's the maximum this center strike could be? Well, that's what this calculation is showing up here, which we did in the presentation. We know that 5 plus 2 is 7, divided by 2 is 350. The most this could ever be worth is 350. Why? Because if I make that 350, we have 0 losses. Now, it's not an arbitrage because we don't have a guaranteed gain, but at the same time, we can't take a loss. But if this price becomes any more than that, let's say 360, now you see that little white space under there? Now we have an arbitrage. And that's how we know that this center strike cannot be more than 350, or the average of these 2 outer wings. So now let's try a broken wing. Let's do 100, 105, and maybe a 120 strike. That's what we saw in the presentation. There's the graph that we saw. But how could I balance these? Now, if we do the calculation that we did in the presentation, we can see that that center strike could not be worth more than 425. That's taking 75% of this price plus 25% of that price of $2 and adding them together. We get 425. So if I make this 425, now you're probably thinking, well, how come we're not leveling out to 0? When we did this with a standard butterfly, we didn't have an arbitrage, but we also couldn't take losses. So it doesn't look like there's really an edge here. But there is if we push it a little bit further. Let's make this, we'll make it 450. So now we definitely have a favorable pricing relationship, but notice that you can't see it in the broken wing. Theoretically, this is still a good trade, but here's my point. Why would you put this on and still potentially take an $8 loss when we can balance them and get money for free? So we know that the balancing factor here is 3 to 1. So if I buy 3 contracts of the first and 1 of the second, now you might think that's not looking too balanced, but remember we're long 4 contracts, 3 plus 1, which means I would have to be short 4 in the center to balance out. And there we go. And you can see it's an arb. The entire thing is above 0. But you can't see that when it's a broken wing butterfly. So again, why would you do the broken wing when you've got a pricing advantage that you can just arb it out and get free money? Do it as many times as you can. You can't lose. So if there is a pricing discrepancy that makes a broken wing butterfly look attractive, most of the time we could just balance them out and create an arbitrage. Now again, because those are few and far between, then you have to say, well, what's the point of doing the broken wing? So this is something that's super important to check, are these pricing relationships. If you can buy this one for less, maybe $4.60, watch what happens over here. Gonna shift even higher. If I can do the same thing over here and pay less, it'll do the same thing. Let's make that $1. See, it shifts higher. So if a pricing discrepancy does exist, again, most of the time you wouldn't just jump on a broken wing butterfly. So why would you use one? Well, this is where we start getting into embedded butterflies. It's what most butterfly traders miss. Let's say that you buy one $100 call, sell 2 of the 110 calls, and buy one 120 call. We still have a 1 to 2 to 1 ratio, equally spaced, separated by 10 points. So that's a standard butterfly. Let's say that the net debit is 2. Max gain, of course, is 8. And that's because we would call this a 10-point spread, either the difference between the first and the second, 10 points, or between the second and third. They're just 2 vertical spreads. So if we pay 2, the most we could make is 8. But the question is, how many butterflies do we have here? And if you talk to most traders, they'll say, well, what do you mean? It's just 1. 1 to 2 to 1 ratio. We put that butterfly on because we think the stock is going to sit still. Again, bad idea. So here's why. Here's our 100, 110, 120 butterfly for 2, max gain of 8. But notice we have a lot of what are called embedded butterflies inside of here. So where are they? Well, if we looked at the 100, 105, 110, these 3 consecutive strikes here, that is another butterfly. I could look at the 105, 110, 115. There's actually 2 more butterflies right there. And I could look at the 110, 115, 120, and there's another butterfly. So take a look at what happens. We have a standard butterfly at 100, 105, 110. I have 2 butterflies at 105, 110, 115. Right there, that's a 242 butterfly. And then I have 1 butterfly at 110, 115, 120. And if we put these on, these 3 trades, notice that these 2 right here cancel, and these 2 cancel. You're long 2 and short 2 in both cases. What does that leave you? Leaves us 1 out here on the wings. Here we have +2 minus 4 gives us -2 in the center, and +1. And look at that, we have a 1, 2, 1 for the 100, 110, 120 butterfly. So it really is made up of a single butterfly here at these 3 strikes, 2 butterflies here in the center, and 1 butterfly out here on the right side. And there they are. Now you might think this is some type of visual trickery, but let's see if it works out mathematically. Let's start with the black butterfly right here, the 100, 110, 120. We put that into a pricing model, and let's say that it comes up with a value of 386. Well, keeping all those prices the same, let's check the 100, 105, 110. And that same pricing model is going to tell us that this blue butterfly over here is worth 94 cents. It's going to tell us that the 105, 110, 115, here in red, there's 2 of them, are worth $1.03 each. And then it's going to tell us this one in green, 110, 115, 120, is worth 86 cents. So if we add up all of these individual butterflies, what do you suppose we get? We get exactly 386. So you can see that they are, in fact, exactly the same thing. So it's just to show that whenever you have a very wide butterfly, which you do by definition with a broken wing, you've got lots of little butterflies in between there, what we call an embedded butterfly. So let's try another one. What about the 100, 120, 140 butterfly? Now we're 20 points wide. I have a butterfly here. I've got 2 here, 3 here, 4 here, and then 3, 2, 1. There are actually 16 butterflies in that. And one way to figure that out is to count the number of steps to get to the center. So we're long the 100, we're short at 120, so there's 1, 2, 3, 4 steps to get to that center strike. 4 squared is 16. And those are your 16 butterflies right there. 1 plus 2 plus 3 plus 4 plus 3 plus 2 plus 1 gives us 16 butterflies. So the thing that for most traders that's going to say, why am I putting on this broken wing butterfly? It's not because we initiate it that way, but it's because we start out with a standard butterfly, and when we start pulling out these embedded butterflies, we can end up with condors, butterflies, broken wing butterflies, ratio butterflies. We can end up with different types of butterflies. And we're willing to take those risks because we've now shut down these embedded butterflies for very nice gains, probably pretty close to the maximum. So as the stock price moves up or down, I might be able to close this one in gray, close to a maximum. But if I do that, I'm pulling some of the strikes out. Or maybe the stock moves up here and I can close this one in blue because it's trading near a maximum. And that's going to leave me another risk graph. So the main thing to take from this is don't trade a broken wing butterfly just because it's a cool sounding name or because you think it's going to give you all kinds of profits for no risk. The reason that you want to trade them is because there is some type of an apparent pricing edge in your favor. And one of the ways we can figure that out is to look at that 3-strike pricing relationship. But if you do happen to find one, you're probably better off doing a balanced version of it as opposed to doing the broken wing, which is still going to leave a lot of risk open on one of those wings. So the reason that probably more traders end up with a broken wing butterfly is because they start out with a standard butterfly like this, they have a lot of embedded butterflies, and as they start peeling them out, they end up with a broken wing butterfly. So I know it's a lot to take in. I hope it at least gives you some insights into broken wing butterflies and why we use them. And if you still have questions, please post them to the group. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.